Hello, I'm Rodney Jones and welcome to this first video in the Evaluating Farm Financial Performance section of this overall educational program. In this section of the overall farm management educational series, we focus on evaluating farm financial performance, or figuring out how we are doing financially. This is important because often indicators that at first glance one would think would be good indicators, such as how much money we have in the farm checking account at any point in time, for example, can turn out to be very misleading. We need a systematic mechanism for monitoring and keeping track of financial position and progress over time. Financial analysis really is all about putting those basic financial statements that we talked about in other sections of this educational series to work for us, or using the information contained in those various statements to tell us things about our business. Sound financial analysis can help us to identify problems as they develop so that we can get a handle on them before they get out of control. It helps us to correct management errors and can help us to avoid mistakes, perhaps costly mistakes, when problems do develop. Good financial analysis can help us to limit losses that result from those problems. Systematically monitoring financial performance can help us to identify things that we are really good at and opportunities that we may be able to capitalize on. I like to say that frequently monitoring financial performance helps the farmer maintain control or run the farm instead of the farm running the farmer. Three basic methods are routinely used for farm financial analysis: monitoring trends in important measures over time, comparing your farm's actual performance to benchmarks, and evaluating performance using key financial ratios. These methods are not mutually exclusive. For example, a farm might look at trends in key financial ratios over time, or the benchmarks that a farm might be using for comparison could include financial ratios, for example. Trend analysis involves simply choosing a few economically important measures to track, monitor, and compare over time. In this example, we see purchased feed expenses appearing to increase considerably over the 4-year time span. Is this a signal of a developing problem? We have to put it in its appropriate context and be able to make that determination. Is the livestock enterprise growing over time proportionally with the increase in feed expenses? If so, this may be an expected result. However, if not, this could be a sign of a problem, feed waste or inefficiency, for example. The second example measure here is crop revenue. It appears to be trending downward. Is this a signal of a potential problem? Again, we need to put it in context to be able to tell. Have we reduced crop acres? Are we in a period of lower prices that hopefully will correct over time? Or are we in a period of unfavorable weather patterns, again, that we think will be corrected over time? Even if the trend is caused by some force outside of our control, an external factor, such as low prices, we still need to be aware of what is happening so that we can best position the business to respond to the trend. The second analysis tool is known as benchmarking. Benchmarks, or comparison targets, can come from inside our own business or record-keeping system, or they can come from sources outside our business. One common internal benchmark is your own history over time of some measurable outcome, such as feed costs or wheat sales revenue, for example. Look at trends over time, like the previous example, and have a target or benchmark of improving that particular measure by some amount that the manager determines. Another common internal benchmark comes from a budget. It could be an enterprise budget where the manager would calculate a projected break-even yield for a particular crop, for example, then add a little cushion for profit to that number and use that as a benchmark to strive for. It could be a cash flow budget where the manager projects an operating line balance at the end of June, for example, and the goal is to have financial performance during the first 6 months of the year such that that balance turns out to be at the budgeted level or below. If the manager discovers that certain cash outflow items are exceeding budgeted objectives early in the year, additional efforts can be directed to trying to keep those costs under control so that the overall budget will be met for the time frame being examined. The bottom line, budgets of various types can serve as an excellent source of internal benchmarks or targets to strive for. Another place to look for benchmarks or targets to strive for is from external sources. Results for key measures from comparable farms are an excellent source. Comparing your farm's performance regarding key measures of financial performance with other farms that are experiencing similar weather and price conditions can prove to be a powerful management tool. Questions like how does my farm's cost per bushel to produce wheat or cost per pound of weaned calf compare to other farms can be answered by looking at such measures. While we do not have a broad-based, comprehensive farm benchmark data source specifically for Oklahoma farms, we do have some nearby sources of very relevant data. Kansas Farm Management Association is a good source for Southern Plains agriculture in general, and there are other data sets to look at as well, such as the Cow-Calf Enterprise Standardized Performance Analysis data, much of which comes from our neighbors in Texas. The third common financial analysis tool is financial ratio analysis. Farmers are very familiar with the concept of ratios. We use them all the time to talk about production aspects of our businesses. Terms like bushels per acre or feed per pound of gain are routine topics of conversation around the farm. Financial ratios focus on key financial performance information drawn from the financial statements talked about in earlier sessions. The whole purpose is to identify areas of financial performance that the business is strong in versus areas of financial performance that might need improvement. Knowledge of our business's financial strengths and weaknesses helps provide direction and helps to focus our management efforts. Here we will talk about ratio analysis in the context of broad categories of financial position and performance. There are 5 broad categories of financial position and performance. Each category tells us something different about our farm. Therefore, it is critical that at least one, if not more, performance measures be tracked that document performance in each of the 5 categories. I will briefly discuss specific measures for each category in just a moment, but first, a brief introduction to the 5 categories themselves. The first category is liquidity. Liquidity is defined as the ability to meet short-term financial obligations or keep the bills paid when they're due. Financial disruptions can occur when liquidity is not adequate. The second category is solvency. Solvency is simply the degree to which the value of the assets exceeds the value of all debt obligations. This is a measure of how wealthy the business is. The third broad category is profitability. That term profit may well be one of the most misused and misunderstood terms in all of agriculture. True profitability is a measure of returns or revenue over and above all costs or expenses. Profitable businesses generate enough revenue to not only pay expenses, but to grow over time, replace machinery on a timely schedule, and contribute financially to the living standards of the business owners, managers, and workers. Financial efficiency, the fourth category, is a general term used to represent how well the assets of the business are being utilized to produce income. Our capital inputs and operating inputs being used to generate the value of production that is needed. Obviously, financial efficiency is one component that contributes to the profitability of the business. Finally, repayment capacity is the fifth broad category of financial position and performance. Repayment capacity represents the ability of the business to meet principal and interest obligations. Lenders are, of course, very interested in repayment capacity, as they want to assure that there will be money available from somewhere to make the principal and interest payments. While there are some similarities between repayment capacity and liquidity, there are also some differences. Liquidity is a measure of the ability of the business to meet all short-term financial obligations, whereas repayment capacity is specifically concerned with the ability to make the debt payments of the business. A group of agricultural lenders, accountants, and farm financial analysts, known as the Farm Financial Standards Council, has endorsed a set of measures and standardized methods for calculating those measures to address the 5 categories of financial position and performance that we just discussed. The Farm Financial Standards Guidelines is sort of the generally accepted accounting practices for farmers, and in many cases the measures endorsed are the same as those utilized by the broader business community. There are, however, in some instances, some unique features to address the fact that agriculture is in many ways a unique industry. So let's talk about a few of the most common measures endorsed by the Farm Financial Standards Council for each of the 5 categories of financial position and performance. By far and away the most common liquidity measure is the current ratio. It is simply the value of the current assets divided by the value of the current liabilities. Both of these measures come from the balance sheet and were discussed in the balance sheet segment. Most people use end-of-year values. Some analysts recommend using the average of the beginning and ending values off the balance sheet. The important thing is to be consistent in your method for your particular farm. Another commonly used liquidity measure that is not a ratio but an absolute dollar value is simply the value of current assets minus the value of current liabilities. This measure is simply referred to as the absolute level of working capital. The most common solvency measure that I see utilized is the debt-to-asset ratio, calculated just like it sounds by taking the total value of farm liabilities and dividing by the total value of farm assets. Both of these values come from the balance sheet as discussed in earlier segments. Other ratios that are in use include equity to asset and debt to equity, which are of course both directly related to the debt to asset ratio, so it's just a matter of interpreting the numbers in context. Finally, a commonly used absolute measure of solvency is simply the level of wealth or the level of net worth. Absolute measures like this one are not really very useful for comparing across farms or individuals, but they are useful for measuring one's own progress over time. A widely used measure of profitability is return on assets, or ROA as it is referred. This is a measure that can be compared to other rates of return to capital and could also be referred to as return on investment. It is calculated by taking net farm income from operations, adding back in the interest expense, subtracting off an opportunity cost for any unpaid labor, and dividing that total by the value of the farm asset base being managed. Net income and interest expense are numbers that come directly from the accrual income statement for the time period being evaluated. The value of unpaid labor should represent what the operator's time could be sold to someone else for, or some estimate of the going market wage or salary for those individuals who have worked on the farm but have not been directly paid. The absolute level of net farm income is another common profitability measure, but again, it cannot be compared across farms or to other investment alternatives. It is, however, a good measure to look at for an individual farm over time. Finally, rate of return on equity is a profitability ratio that measures whether and how quickly the ownership interest in the business is growing or shrinking. Several ratios are commonly used to look at individual aspects of financial efficiency. One of the most common and most comprehensive is the asset turnover ratio. Gross farm revenue, before subtracting off any expenses from the accrual income statement, is divided by the total value of farm assets managed from the balance sheet to arrive at a measure that basically reveals how well the assets on the farm are being utilized and converted to income or revenue. Other financial efficiency measures zero in on specific financial areas. Examples include the operating expense ratio, the interest expense ratio, and the depreciation expense ratio. These specific measures reveal if expenses in certain areas are in line with expectations or industry norms. Similarly, the net farm income from operations ratio reveals in percentage terms how much is left over after paying all expenses. Details regarding how to calculate these additional measures can be found in the resources associated with this educational program. A good example is the Evaluating Farm Financial Performance publication. And benchmarks regarding when calculated measures are considered good or are a sign of caution that an area of financial performance needs to be monitored can be found from several sources, including the Farm and Ranch Stress Test publication that is included in the resources section as well. We will provide additional clarification in other recordings associated with this section of the educational series. Finally, with regard to the last category of financial position and performance, the term debt coverage ratio is one of the most commonly used indicators of repayment capacity. Basically, the sum of all of the funds that could be used to make debt payments is divided by the principal and interest payment obligations for the upcoming year. Funds that could be used to make debt payments include the net income from farming, plus any non-farm income, plus depreciation expense. Remember, that is a non-cash expense that was subtracted out in the calculation of net farm income, so we add it back in as cash available here in this calculation. Plus we add interest on term debt minus the taxes, minus any family living withdrawals from the farm to get net cash that could potentially be available to make principal and interest payments. Information to calculate the term debt coverage ratio comes from the accrual income statement and from the cash flow. Thank you for listening to this basic background regarding farm financial evaluation. The next few videos go into a bit more detail, specifically using the example case farm numbers that were developed for this educational series. Again, thank you.